and going through and either finishing your reading or finishing the questions. So now we're going to do, like we did in session 1, a session 2 live-inar. It's not a webinar, it's more of a seminar, but you know what I mean. We're going to have our welcome, introduction, investing, what is it? We're going to be talking about investing productivity, and then we're going to do a homework and wrap-up exercise. Who's starting to become a little bit more familiar with the way these things are structured? All right, good. Session 2, part 1, introduction. So a key message that we learnt from session 1, now we've got key messages and things to cover, is that fatalistic investors underperform financially and fail to reach their full potential. Key reflection from last session, how does your current level of competency reflect your current investment results? That's a harsh question to ask. If you're not happy with your current results, maybe it's because you're incompetent. Well, that's something that we can fix. Key application from our last session, what's the one thing you can do right now to increase your investing output? The idea is we begin the next webinar by quickly going back and revisiting a starting point from the previous webinar. Why? Because although some of you will be watching the webinars sequentially, one after the other, maybe the same hour, the same day, the same week, for some of you there might have been a break between the webinars. So going back and quickly reconnecting you to what happened with the previous webinar is a helpful way to bridge if needs be. The key questions that I'd like to answer in this webinar are, what is investing? Make sure we're all talking about the same thing. How can you become a more productive investor? Because you'll soon see that being a more productive investor is the key to earning higher profits with less effort. Which I'm pretty sure you all want to do, right? Good. All right, session 2, part 2, investing, what is it? All right, let's do some word association. When I say the word investor, what comes to mind, Aaron? Money? Tess? Investor. First thing you thought of? Me. Pass? Housing? Shares? Buy and sell? Knowledge? Property? Intelligence? All right, so when we're thinking about investing, the word investing in and of itself means different things to different people. And what I wanted to try and do in this webinar is bring investing back to a basis that we can all agree on. And indeed, one of the ways that I teach, albeit very academic in some ways, is to bring words back to definitions. And if we can understand the definition and agree on the definition and then pull the definition apart, there is actually detail in the definition which adds real substantive meaning. So let's do that right now. Really, when we think about investing, there are two types of investing that exist. There's social investing and there's profit-orientated investing. Let's look at social investing for a minute. Social investing really has a scope of acceptable return, which may include financial and it may include non-financial considerations. No one here in the room is probably going to invest in building a regional road that not many people drive on. But it may be that there's been 5 fatalities on that road, and so there's a social investment that needs to be made in that road to stop more people from dying on it. It may not stack up from a financial point of view. Public housing. The returns on public housing are so low that I doubt anyone in the room would rush to invest in public housing. Although they tried it with NRAS by offering some sweeteners, right? But even with that, this idea of social investing needs to happen for non-profit orientated returns and projects to get off the ground. So when we look at social investing, we're talking about benefits to the community, we're talking about benefits to your family, and we're talking about benefits to yourself. For instance, when you own a home's an asset. I know, I've read the same books as you that tried to tell us that owning a home wasn't an asset. In fact, I remember one book where they even went so far as to say your home is a liability. Nonsense, all right? I'm the chartered accountant. I'm here to tell you that your home is an asset. But it's a, what kind of asset? It's a social asset. Also, as in the course later on, I'll describe it as a lifestyle asset. It's an asset you own because you want to and can afford to, ideally, not an asset that you own because you can't afford it, because that will then stymie what you can do with your other investing. So social investing exists for the community, for your family, lifestyle, relationships, succession planning, or it's a benefit to yourself. It's an achievement, helps you be more productive, it's a capability, might even assist you with your risk mitigation. Going out this afternoon and buying a fancy new red sports car, is that an asset? No. Yes. It meets the definition of an asset. If you borrow for it, the borrowing portion of it is a liability, but if you go and pay cash, that thing is still an asset. If you then went and sold it the day after, you probably wouldn't get what you paid for it, but you'd still get something, and so it's an asset. It exists for a future benefit. But is it a profit-orientated asset? Well, no, unless it's some kind of collectible car or something else that you hope to own for a profit. It's a... All right, so here's the application. How many of your assets are social assets? Is your home a profit asset or a social asset? It's a social asset. If your home is a profit asset, a profit-orientated investment, the psychology associated with buying a home and trying to profit from it are two worlds apart. Very, very difficult to make work. Profit-orientated investing, therefore, is for a financial return. What kind of return? You're trying to, starts with make, ends with? You're trying to make money. That's why you own it. Do you own your home to make money? No, you own your home to live in it, to enjoy it, to raise the kids in it, to live to a long and merry old age in it. You own your home because that's where you want to own a home. Your investment property, do you own your investment property because you love landlording? No. Do you own your investment property because you're trying to do tenants a favour? This is an important point. Do you own your property because you're trying to do tenants a favour? No. You own your real estate with a financial return as the prime consideration. It's not the only consideration, it's the prime consideration. So the questions you need to ask when investing in profit-orientated investments are, first of all, how much down? How much of your money do you have to kick in to buy it? The second question then is, well, how much am I going to get back? How much of my money down for how much money back? For how much time? For how much? No, return is back. Risk. Good. For how much risk? Remember before I talked to you about how do you overcome doing risky projects that other people can't stomach? And I said there were 3 things you needed to do with risk. Does anyone remember what they were? Name it. Num it was 3. Middle one was? Number it. Good. Name it, number it, num it. So what we're trying to do here is give our risk a context by asking how much of our own money do we have to contribute? How much money down? How much are we going to get back? How much time is it going to take to get that money back? And how much risk do we foresee associated with it? When we can change our focus from let's make money to how much down, back, time and risk, we become more sophisticated in our decision making. In fact, a subsequent, down, back, time, risk is something I've been talking about for 10 years or longer. Subsequent to that, with my investing in the United States of America, I changed the formula a bit. Down, back, time, risk is still important, but now I say to people, your investing wants to give you, say it with me on the screen, the what kind of profit? The most profit, and there's a word at the end. Okay, the most profit for So the most amount of profit in the quickest time for the lowest risk. Anyone know the last one? Oh, those people who... Good, the least aggravation. And as we evaluate investments around down back time risk, we also need to evaluate investments around, right, what's going to give us the most profit, the best return, in the quickest time for the lowest risk and the least aggravation. It may come to pass that, let's say that we do a reasonably complicated project, which is a subdivision, get plans and permits, and then we're contemplating whether or not to build. If we decide that we want to build, what does that add? Well, it adds risk, because now we're borrowing more money and putting out more of our own money in. It adds time. Hopefully it'll add. And will it add? Now, is it worth, definitely, is it worth the extra aggravation, risk and time for the profit? In real estate, we're not trying to do the most profitable deal, full stop. We're trying to do the most profitable deal within the context of time, risk and aggravation. It may be that you're better off earning a lower return that you can make more often with less risk and aggravation than the mother of all home run deals every time. Okay, this is an important point, which I know it's after lunch, and sometimes after lunch we get sleepy. But here's the important point. You may be better off earning less. I'll say it one more time, it's an important point. You may be better off earning less if you can make less more often with less risk and aggravation. I know seeing a picture of a beautiful piece of real estate, I've made $1 million, makes for a good story, but I'd rather you be able to make $30,000 on a $200,000 investment in 6 months than $1 million you did once with a whole lot of risk and was sheer fluke. Now, with investing, the whole notion of investing relates to this principle of exchange. And the principle of exchange is receiving a benefit in for allowing to something you own. Okay, so you read this in the notes, you may have glossed over it. All right? So the principle of exchange is receiving a benefit in exchange for allowing someone to use or borrow something that you own. In a real estate transaction, what is the benefit? Money? Well, let's be more specific. Capital gains or rental. Thank you. What's the exchange?
Ability to live in or the property itself.
Correct, to use the property. Who's the someone? Tenant or eventual buyer. What do they use or borrowing? The property. All right. Here we go again. Now we're starting to bring some reasonably basic theory into a practical application. If you want to maximize your end sales value, i.e. you want to maximize the potential a property could be worth when it comes time to market, who do you need to maximize the appeal for? And who do most people appeal for? Themselves or the agent, and the agent just wants to sell to anyone, so they cast the net as wide as possible. Whereas what we've learned here is that the principle of exchange means that if we can exchange the property for something that someone wants to use or borrow, and we can be more specific with the person and try and find ways to improve the benefit for them, then we will be rewarded. You want to make more money?
Yeah.
You tailor your real estate for the person whose benefit it is that they will be using it. I'm not sure if that made quite the Queen's English, but if you want to make more money out of real estate, you want to rent for more, you want to sell for more, then you think about who is the someone, what is the benefit, and how can I add more convenience, or how can I add more ease of use? How can I make it more valuable for them? All right, so let's take a look at these things. What's the benefit? What's the big picture benefit? The big picture benefit, is it money? No, they're not interested in paying you money. They want to pay you the least amount possible. They want a bargain. When you buy something, Tom, do you want a bargain?
Always.
Yeah, I want a bargain. I don't want to be ripped off. And so, who wants to buy my overpriced house? No one's lining up to do that, are they? So, is the benefit for you? No, it's the benefit for the end user. What is the benefit? You get to live in my house, but don't ever ask me for anything. No. You have to try and think about what benefit am I providing and how can I provide that benefit better. Now, when we look at the benefit, what is the monetary benefit? What are the upside components, downside components, and other considerations? So, we've looked at the benefit for the person using the property. What's the benefit for you? And is there enough benefit, is there enough back for you to want to let someone use your asset? It may not be. Once again, connecting your benefit with the user's benefit allows you to see the property transaction in the big picture. Exchange, what are you giving up in exchange for the benefit? Well, when you buy a piece of real estate, you're paying cash, so you're giving up usually some cash. Borrowing ability you're giving up to buy this asset. Borrowing ability is one of these things that once spent, you can't necessarily get it back easy. You need to sell to refresh. Time. What else you could be doing with your money? Buying that shiny red new sports car instead of the property. Safety. Your financial future, the safety of your family. And non-financial considerations. When I started off investing, I chose to rent. Why did I choose to rent? Because the working capital that would have been allocated to owning a home, if I could only get a loan for 80%, it means I needed to come up with 20% plus closing costs, wasn't earning any income return. Might have been earning a capital growth return because it was invested in a house that I was living in, but I wasn't getting any income return. And capital growth, I couldn't go to the supermarket and spend. So I needed an income return. In order to get an income return, I had to buy property. In order to buy property, I had to get the most money I could. In order to get the most money I could, I had to rent. In order to rent, I swapped something. I swapped the safety of being a homeowner. So who's the someone? Why do they need it? Why are they motivated to exchange? The more motivated you can find someone who wants to exchange with you, the higher the price you'll get. You guys read all this in the notes, didn't you? See how the webinars allow me to bring different concepts to life, which I don't just want to write down in a theory context. How can you make the exchange more appealing? Because they'll pay more if it's more appealing. How do you gauge quality? Are people willing to pay for quality? And what protection is there against default? So you make an exchange. Thanks, I'll take that. I want that back. I'm not paying the rent. I don't close on the sale. What's the protection in that case? Use or borrow. How is the exchange going to be used? How might it erode? So if you've got a tenant in the property, I think you pretty much know you're not going to get it back in the same condition you gave it to them as. So how's it going to be depreciated? How can your exchange be reused? This all might seem like a little bit arbitrary in its discussion, but these are the questions you need to consider. This is the investing skill and expertise that, as you unpack these concepts, will help you to be more sophisticated and make more money. I know it's not the most riveting thing to be talking about today after lunch, but when you're sitting down and you are contemplating, how can I make more money? Everyone goes to, I'll just buy another asset. But the reality is, if you can use what you've got more effectively, then the easiest place to make more money is with what you've already got. So how can I make better use with what I've already got? Well, these are the questions you need to ask. You need to unpack the principle of exchange and then say, is this a fair exchange, Graham? You give me a Mentos, which is worth what?
Nothing.
10 cents? Here you go, for my $500 pack. Let's exchange. All right, you're happy with that exchange.
No worries.
Now, I'd be happy with that exchange if I really wanted a Mentos more than I valued the pack, right? So we need to find people who value the Mentos more than the pack. What's the Mentos? We're an investor. What's the Mentos? The property, being able to rent it or buy it off us. And what's the pack? Money. They're going to swap their money for this Mentos. And the more they want the Mentos, the more they're willing to swap for it. So, right, now we're starting to, everyone's handing out Mentoses now, right? All right, so now the principle is, how do I find out what people want? And then once I've found out what they want, how do I figure out how much they're willing to? Now we've entered the realm of investing. Because investing is about the principle of exchange. If I can find someone who wants to exchange their money with what I've got, and I can emotionally enroll them in the benefit. Did we talk about benefits today? Everyone say yes. You know, we just unpacked benefits. If I can enroll them in the benefit of wanting the Mentos, Mariana, you really want this Mentos. This is the best Mentos in the entire room.
Yeah.
Just think about how you'll feel sucking the outside of it.
Classic.
Yeah. All right. This is just a sugar pill that will kill you.
Oh well, you gotta die.
You seem more excited by the second option. All right. The truth of the matter is, we need some marketing expertise, which is part of investing, which we'll cover in the course, to help you to dress the Mentos, the property, in its best light so that the money will be swapped for it. That's what we're talking about now, if you're lacking the concept. And we're unpacking the principle of exchange in its various components, figuring out if we know how the asset is going to be used, we can then figure out how can we market it so that it will be used in its best light. If it's going to be used by students, Tess, is there any benefit whatsoever advertising families? No, it's the wrong target market. So we need to be very careful about understanding the notion of how it's going to be used and how it's going to come back to us and various other things. What's that secret of wealth creation? All right. How can you prevent the unauthorised use? Great, so I'm renting to you and 50 of your mates come round to have an extended sleepover for a year or two. So there are legal complications and issues that we need to think about here as well. Now, something you own, what is it? What is the thing that you own? Normally it would be a house, but is there something that you have in your social assets that you could convert into a monetary asset by letting someone use it? I don't know. But if we can swap a social asset to a profit-orientated asset following the principle of exchange, maybe not, it's worth our while in doing so. And we're talking about own, so now the issue of structuring comes in. How do you own it? In your own name, in a company, in a trust, a super fund? What's the best, most advantageous way of owning it? And let's look at an example. Let's say that we lend money to a family member. Anyone ever done that? Yeah? Lent some money to a family member? Hands Peter, are you looking at Peter or is Peter looking at you? Both? Righto. So, consideration number one, what type of investment is it? A social investment or a profit-orientated investment? Think about it. Just pour myself a little glass of water here. Who says social? Who says profit-orientated? Who's not putting their hand up no matter what? A couple of people. All right. Depends if there's interest or not. An interest-free loan. Does such a thing exist? All right, well, that's consideration number one. What kind of investment is it? It's not for me to say, because it depends on you and how you view your family. I don't know that interest-free necessarily works because there's no motivation in paying you back. I think there ought to be interest, but whether you charge that interest is up to you. Consideration number two, what is the benefit? You lending money to your brother, sister, mother, father, uncle, aunt, niece, nephew, cousin, is it a financial benefit or a non-financial benefit? All right, next question. What is the cost to you to exchange? Not only the money, but also the interest that you don't get on that money.
Opportunity cost. Family never leaves.
Well, the opportunity cost of, what else you could have bought it in shares and you might be missing out on capital appreciation. Consideration number four, who is the other party? Well, it's my family member. Do you ever bother to ask, why do you need the money? Yeah. Is it your business?
Yep.
Do they have the capacity to repay? I promise. Scout's honour. How will it be used? What are the mechanics of the transaction? How am I going to give you the money? Is it $50? Or are we talking about $50,000? Am I giving it to you in progress payments or do you want it all today? Is it secured or unsecured? What are the repayment terms? Is it documented? So we're talking about consideration 6 in terms of ownership. And then let's look at the conclusion. Let's say that a family member wants $10,000. How much down?
10,000.
How much back?
0.
Assuming no interest, 10,000 back. How much time? Oh, could be anything. For how much risk?
10 grand.
For how much aggravation? If it all goes well, you might get a thanks. If it all goes pear-shaped, it might all look really nasty. Do you see how now as we start looking at assets, we're looking at assets from a different perspective, a more sophisticated perspective. We're not simply looking at return in isolation. We've now pulled the transaction apart to be looking at return, to be looking at the type of investment, who we're making it to, this principle of exchange. Am I getting the bum deal here for helping out? As my mentor says, Stu Silver in the United States of America, no good deed goes unpunished. All right? Remember that when you're asking for your money back. So, what's the application? You don't mind if I leave that there, do you? What's the application? What I want you to do is reevaluate. What do I want you to do? All of your investments according to the investment definition parameters. All right, and as you do, I want you to use this template. Now, this is a template you can download from session 2 off the website. What do we look at? The investment. What do you think S/P stands for? Yeah, social orientated or profit. What are the benefits to you? What are you giving up? Description of the interested parties. How your exchange is being used. I'll fix that up. And then ownership or mechanics. What is the cost of making social investments? Your financial future. I put it to you that social investments are fine, but pay for your social investments out of profit, not lost opportunity. Now, a crisis is a crisis is a crisis, and blood's thicker than water, and it's not for me to tell you what to do or not what to do. But I think it's much more sustainable to share the wealth around once you have wealth, rather than everyone be poor together. Sometimes, not always, the kindest thing you can say is no. Now, the blowback from saying no may not be pleasant, but if the blowback from saying no is not pleasant, it'll be a lot more pleasant than you trying to have to enforce payment of an underperforming loan from a family member. Session 2, part 3, investing productivity. All right, everyone stand up, have a stretch. You've been sitting down long enough after lunch. Once again, try and touch the roof. One hand up, one hand down. Other hand, other hand, other hand. Clapping together. Out to the side. Give me a big groan. Take a seat. So, investing productivity. Productivity, by definition, is having the power of producing. Huh? Well, how powerfully producing are your investments at the moment? What is investment output? Come on, we've looked at it today. What's investment output? Profit, good. And what kind of profit are there? There's two ways. No, not passive or active. It is capital appreciation or cash flow. Good. This is the meter. This is empty. This is full. How producing are your investments? Do you even bother to measure? If we want to be more productive, we want more output. That's what we're talking about here. So the principle, the secret to increasing the pace at which you accumulate wealth is twofold. The first is to get the highest possible return. The higher the return, the better. And we looked at that in the notes, didn't we, when we talked about compounding. And the second is the faster, the better. If we want to be more productive with our investing, we need to earn more faster. Good. All right, we need to earn more and we need to earn it faster. So how can your investments be more productive? Well, you can get more output, or you can get better efficiency. So output relates to profit, whereas inefficiency relates to expense, wastage. Here's a potential aha moment. You may not need any more assets. You might only need more output or efficiency from your existing assets. Everyone's running around trying to get more. For those people who already have a lot, it might be for you a question of reallocating, or what I call redeploying your capital into higher yielding or less wasteful investments, and you're financially free. You've achieved your goal. Let's high five each other and go home. You might be closer to financial freedom than you've ever really thought. You've just never had anyone show you how to put the jigsaw puzzle together. Okay, so let's have a look at this a bit more. Before you buy a new asset, I want you to ask, how can I achieve a greater output or efficiency from my existing assets by either finding a way to increase the return or finding a way of increasing the compounding frequency? How often it compounds, daily, monthly, weekly, etc. Not that anyone does this, but I'll give you an example. Rent in Australia is usually calculated by the minute, hour, day, week, fortnight, or month. Week. But it's paid monthly. So one way you could improve your compounding is to be paid weekly via direct debit. We can do that these days. Remember, the rental system was born out of people coming in, getting paid fortnightly, cash folding money, coming and paying their rent. Technology has moved on. Why can't you be paid weekly? Does it make a difference, direct debit per week or per month? You might get paid by the month up front, but why can't you get paid weekly?
Can you demand that of the agents?
Can you demand? You can demand whatever you want.
I asked for that, but they have a policy, they just do it, they actually get paid fortnightly.
Okay, Tess.
Depends
Wait. What did I say before? If you don't like the answer, you ask a different. And if you don't like the answer, sometimes you've got to find a different advisor. So if your rental manager says, our policy is to do X, Y, Z, you know where you can shove your policy? It's funny because my policy is to collect the rent weekly. What are we going to do about it? Do you want me to show you my policy where it says I collect the rent weekly? Let me just type you an email. Send. Now you have the policy. You've heard it said you usually leave how much of a deposit when you buy real estate? 10%. I have a policy for that too. Do you want me to send it to you? My policy is $1,000. Send. See, again, remember, when you don't know, you gravitate to whoever has the strongest. Our policy says. Sounds like a pretty strong opinion to me. And for you to counter that opinion, you need a stronger opinion. I think your financial future is a pretty strong opinion. The question I'd say is, that's great. Why can't you do it weekly? We're not geared that way. Why not? Why not? Well, they may not want your business, in which case you can try and find someone who does. Now, this may not work in every case, but it's a practical demonstration that shows you that compounding is not just an academic exercise. All right? There is application for investing. Is it going to be easy? No, but see how we've crossed into the realm out of just buying something and hoping it makes money to investing skill and expertise to drive an outcome. All right, so let's take a look. The other thing that needs to be said here, I don't know why I don't have it on here, it might be an oversight on my behalf, is how can I achieve a greater output or efficiency by increasing the rate of return, increasing the compounding? I guess it's associated with the rate of return, lowering the expenses. So we're talking about increasing the income. Obviously, I wouldn't be an accountant if I didn't say consider lowering the expenses. In real estate, the number one expense you have is interest. No, interest is always going to be far more than anything else. So if you can get a better deal on your loan, why wouldn't you? Now, later on in the course, I'll talk to you about how it's more important to have loan supply than the interest you pay. And I won't unpack that again now, except to say that every dollar of interest you pay unnecessarily is an extra dollar lost. All right, so now I'm going to start frying your brains. And I know it's after lunch, or it's late if you're watching this at home and the kids are screaming and you need another coffee or whatever. You've had a hard day at work. But we're about to delve into a pretty advanced concept. Are you ready for it? Anyone need a Mentos before we get in? Another cup of coffee? All right, so lazy money. What's lazy money? Investments that are no longer earning the highest return for the lowest aggravation. Could say there. So let's look at an example. Here is a property that was bought 10 years ago. It's a fictitious example. Right? I don't own this property. It's a fictitious example. But it was bought how many years ago? 10. And we paid how much? 200. And it's now worth? It was rented for, and it's now rented for. So it's a reasonably possible example. Good investment? It's all right. Yeah, it's all right. 150 grand, $15,000 per annum. What percentage of your salary is that? Good investment? Yeah. Yes. If you could own 10 more of these, would you be disappointed? No. If you had bought 10 of these 10 years ago, you'd now be sitting on a whopping great big profit. You probably wouldn't have to work. It's just that you were too fat, dumb or lazy to buy 10 of these 10 years ago at 200 grand. Now you wish you did, but you can't. All right? This is a great investment, particularly if you're a growth-orientated investor. Now, is it as good an investment Is it as good an investment now as it was 10 years ago? Really? All right. Our return on investment, annual rent divided by purchase price, when we bought it was $300 a week times 52 weeks. There are 52 weeks in the year. Divided by 200,000 times 100, turned into a percent, was 7.8%. What was our ROI at purchase? Good. Our ROI now is 5.9%. Why is it 5.9%? Because now it's 400 a week times 52 weeks, still 52 weeks, divided by 350 grand. If you went to the accountant, would they give you 5.9%? No, they would probably be dividing it by 200,000 cost to say that your return is this. But we don't divide by cost because that ignores what you could be doing with this money if you redeployed it. So we need to value it based on current market value. So really, our income return has gone, and why has our income return gone down? Yeah, it's close, but it's not the answer I'm looking for. Rent hasn't kept up? No. Let me ask you this way. What income return has the $150,000 of capital appreciation generated? No, is it $100 a week that the capital appreciation is generating, or is that what the original capital base is now generating after inflation? How much extra income has the $150,000 of capital appreciation brought in? None. Somewhere between not much and none. Now, in Australia, typically, property has appreciated faster than rents have increased, so you end up with lazy money. What's the lazy money? The lazy money is the income return you're not getting on the equity. So the property's value has increased faster than the increase in rent, causing the yield to fall. Anyone have this happen with their property portfolio? Own an asset where now if we were doing this, you would be in exactly this boat. All right. So all is okay so long as the growth in value increases, the growth in value increases to compensate you for your loss in yield. What does that mean in English? If your capital appreciation is appreciating faster to compensate you for the income you're not earning on the rent, then everything's okay. But it doesn't always work out that way. because we have markets where we enter into flat periods where there is no capital appreciation and you're not getting any income on that equity increase. Otherwise, you're going to have this lazy money, which means that you're missing out on opportunity cost. Remember this little exercise we did where we had the word property and investor, and you all told me you were investors? What kind of investor are you if you're sitting on lazy money and missing out on money you could be making? What kind of investor are you? No, I've got another word, starts with in. Incompetent. All right, so here is a lot of information to take in very quickly, but I'll try and walk you through, right? This is assuming that over 10 years our rent increased $10 a year and that our capital growth went up $15,000 a year. In reality, it would never be like that, but it gives you some kind of model to get your head around. See how yield has gone down? But also our capital growth has gone down. Why has our capital growth gone down? Because it's gone up 15 grand, but it's gone up 15 grand, but the base has got higher. So 15 on 200 is 7.8, but 15 on 215 is 7.5, 15 on 230, 7.23, and so on and so forth. Our 15 grand has stayed constant, but the value of our property has gone up. So while we're still getting 15 grand, as a percentage, it's actually... All right. Okay, this is important. In real estate, the longer you hold an asset, the greater the chance you end up with...
Lazy money.
We'll say it again. The longer you own a piece of real estate, the greater the chance you end up with... One more time. The longer you own a piece of real estate, the greater the chance you're going to be sitting on...
Lazy money.
And the more lazy money you sit on, the more incompetent you are as an investor. Why? Because of the opportunity cost you're not gaining the benefit of, because you're choosing not to sell because you don't want to pay tax.
Can I ask on that point, Dave? But when you're making a decision, you have to factor in the exit costs and the entry costs into your next investment.
Indeed you do.
Factoring in.
Hold that thought. So when you exit, you have to think about the exit costs, including taxation, and you have to think about the entry costs to go again. Question?
What if you were to use the equity to buy another property?
What if you were to use the equity to buy another
Not to
property?
make it lazy.
Not to make it lazy. And it's still positive cash flow. All right. When you invest, the survey done in the mid-1990s was that 92% of investors only own one or two properties. And so the question that I kept asking myself is, how come so many investors own so few properties? And one of the reasons why they own so few properties is because they refinance their equity and then can't borrow any more money. So they get stuck at one or two properties. How do you fix that problem? Well, you don't want to sell because then you're going to pay capital appreciation. You may not be able to afford to sell because if you've taken that equity and bought another negatively geared property, you may not be able to afford to pay the tax when it comes due because you've got extra losses. So with this course, which might be different to other courses or other things that you've heard, there are 4 phases. How many phases are there?
4.
Analysis and planning. What was that 4th one? What was that 4th one? Now, sometimes you'll refinance if you need a quick money hit. But by selling, and I'm going way ahead of myself here, right? I'm giving you the punchline before I've even told you the joke. When you sell, the profit flows through your tax return. And when the banks ask to borrow more money, because you want to re-borrow and buy more real estate, what do they ask for? Your tax return, and you've earned more, so you can borrow more.
Don't you have to show that 2 years in a row though?
Tess.
Just asking.
Don't you have to show that 2 years in a row?
They
Well, if you are investing the right way and you are buying and selling real estate, if you've got an incubation period of 5 years, you'll have some properties that you've bought and sold. From day one, are you likely to walk into the bank, saddle up and say, I want my $1 million? No. All right. There is a lead time here. But the point is, I need your bottle. I don't know. Sometimes I tell this story, sometimes I don't. All right. Bottle. How they catch monkeys in the forests of Indonesia, right? Some of you may have heard me tell this story. I've read this from a book called Creating Wealth by Robert Allen. Excellent book, suggest you read it. Some years old now, but a great book nonetheless. Heavy glass bottle, little monkey, not big chimpanzee thing, right? They put peanuts in the bottle. The monkey comes along, sniffs out the peanuts, sees the peanuts, decides, peanuts. Gets its little hand, goes through the neck of the bottle, grabs a hold of the peanuts, but now the clenched fist can't get out again. So in order to escape, the monkey has to, but it doesn't want to let go of the peanuts. So what happens is, what does the monkey do? It screams at the bottle, because it's the bottle's fault that it can't get away, all right? And what they do is they come with hessian sacks, throw it over the monkey, take it off the market, gets sold. In order to buy the next property, you will eventually need to sell and let go of the let go of the peanuts. I don't want to sell, I have to pay tax, but I can't buy any more property. But I want to buy. You're just caught arguing with the bottle. Here's your bottle. Name for me one business other than the government that can buy and never sell. If you've got a corner milk bar and you only ever bought newspapers but never sold them, you'd go. If you had a business that you were into IT and computers and you only ever bought computers and never sold them, you'd go. In real estate, we're told that we should buy and never. It violates a fundamental business principle of success, doesn't it? When you think about it. And we're taught that because we've been brainwashed by people who have told us that we shouldn't pay when we should pay tax if it allows us to achieve our wealth creation. So you stay as an accountant, you pay as little tax as you want, I'll be over here making as much money as I can, and I'll do whatever I damn well want with my life, please. If you want what everyone else has got, do what everyone else has done. If you want to be different, if you want to be financially free, if you want to listen to the guy who's bought hundreds of properties, who now doesn't need to work anymore, then don't seek approval from people who don't share your... Otherwise, you're just going to end up conflicted and torn. I know what I teach works because it's worked for and hundreds of other people. Will it work for you? Well, I don't know. It all depends on what other baggage you bring to the table. All right, so you see how yield has gone down, capital growth has gone down because price has gone up. So if we were to chart this, it's a pretty basic chart, but you can see how we started off here and both our income and our capital appreciation return have gone down. That's not what we want to see. Right. If we were to hold that line constant, both in terms of income and capital growth, this is what we would need to see in terms of increase in value per annum and increase in rent. The rent is actually $400 at the moment. It would need to be $540 to still be providing us the same return on that capital base. Interestingly, it's only $10,000 more to keep the capital growth the same, but we need a lot more income. So, velocity of money, all right? What is velocity of money? Velocity of money is a spunky, sexy way of explaining how fast your money multiplies, which is another way of talking about compounding. So remember how I said before, if you want to be a more productive investor, one of the ways you've got to do that is to compound more frequently if possible. And so if we monitor our velocity of money and we have a very slow velocity of money, our money's not compounding fast enough. Let's look at this property again, and let's say that our annual rent is $20,800, which is $400 a week times 52 weeks. And let's say that we've got $150,000 worth of value. Okay? Why? 350 minus 200. Just hold tax and exit costs as nil for a moment for the purpose of this exercise. All right? It is a valid consideration, though. So what you could do is you could wait 7.21 years and end up with 150 grand, or you could sell now and fast forward 7.21 years of rent. All right, one more time. You could wait the 7.21 years, still have capital appreciation, and you'll have 150 grand, or you could say, sell, I'll take my 150 minus sales costs, which won't be then 7.21 years, it might be 6 years or something, 5 years, and leapfrog 5 years ahead. Which one would you do? Well, it makes sense. You would want to try and increase the velocity of your money as best you could. If you can reinvest and get a higher return than what you're getting now. Okay, so the actual capital gain, 150 grand at 4.48, is 6720. The actual rent at 5.95 is 8910. The potential capital gain, if we took that money and reinvested it, 150 at 7.5, is 11,250, and the potential rent is 11,700. What these figures show you is the difference or the opportunity cost that is lost if we could reinvest that money back at the same return that we originally bought the other property at. i.e., if we look at capital gain, we're missing out on what, $5,500 per annum plus another $2,800 give or take in rent. That is the price of our incompetence. What are you thinking?
So, question sort of on the edge of that. Do you take into account...
Do we need a mic? Where's? No, we're okay.
Do you take into account net present value when you're buying and selling?
No, I try not to make it more complicated than it really needs to be. NPV is more of a cash flow indicator, and it is, you could do it if you wanted to do it. I find that if I started talking about internal rates of return and net present values and that kind of thing, this is already a hard enough concept to get. Most people sort of struggle with it, but you could. What rate would you discount at? What do you, discounted inflation seems too low? I don't know. Yes?
The potential capital gain raises big questions. How do you determine such things?
Well, how do you determine the potential capital gain? I'm just saying we were getting 7.8% originally. If we just reinvested that 150 at the original return, then that's what we would be getting. We're actually getting 6720 at the moment. Just on the 150 that's sitting there. Is that a bit clearer second time round? No? Yes?
So now what happens when you add in the expenses of selling?
Now, well, it depends. The question is, what happens when you add in the expenses of selling and buying back in? I don't know, I didn't go that far with this model because we're adding more assumptions to more assumptions. I'm trying to indicate the principle, which is sitting on lazy money and what that might be hurting you by choosing to sit on lazy money. The actual hard number will depend on everyone's circumstances. How much tax they have to pay? Can they find another investment? Okay. I went from 0 to 130 properties in 3.5 years. I went from more than 130 properties to 0 in 3.5 seconds. With the stroke of a pen, I sold all my properties to my business partner. I kept PropertyInvesting.com, the foundation we set up, and he got all the properties. Did I get a bum deal? I also got paid out a substantial amount of money. Right? So I took that money and I tried to invest it at the best return I could. At that time, it was doing renovations and developments. All right? So quick turn real estate, like I taught some of you guys at the Global One seminar. Then I saw the mother of all opportunities in the United States of America. Instead of earning 7 or 8 or 9%, I could earn 30 or 40%. And so my own teaching about said the smartest thing I can do with my money is put it where it earns the highest profit, which is why I ended up in the United States of America. Just to give you a practical demonstration that I follow my own teaching. Now, in the next edition of Australian Property Investor, they're going to feature me as one of the, super gurus or whatever of real estate. And in it, they asked me, how much real estate have I got at the moment? And I said, I don't know. What do you mean you don't know? How could you not know? I've got as much as I need to get $17,000 per month of positive cash flow. Because it's about the outcome. The number of properties is irrelevant. Is it 20? Is it 50? Is it 100? Is it 200? Is it 500? Is it 1,000? It doesn't matter. It's how much do I need to get the outcome that I want. For you guys, it might be 1 or 2 properties owned debt-free. But the point I'm trying to get here with the velocity of money is, as I indicated before, the longer you own a piece of real estate, the higher the chance you're going to be sitting on, because the income return and the growth return will go down over time.
Does that include debt-free property as well?
Does that include debt-free property? Particularly so, unless you have a good reason for owning debt-free property, such as you're in stage 2 of the wealth creation model, which is all about income, and you choose not to have any debt because you want to maximise the income return. All right, so there we go. Current rent of 15, current return 15, potential return of 22, so you're missing out on about $7,000 per annum. So the application, are you focusing on increasing profits by acquiring new investments when it would be easier to make existing investments more productive? We're always looking for the shiny new toy, when maybe the mine that we've got as our existing property could bring some more profit to the table if we applied skill and expertise to outperform. Homework and wrap up. So investing is a lot more than just making money. Do you agree? If it was easy, everyone would be able to do it. Before committing, you want to assess the benefit, the exchange, the person, the use, and the structure. You want to pull apart this definition so you know what you're getting yourself in for. And after you've bought, you want to continually maximise your returns by increasing the return, increasing the frequency, and there should be a C there, which is improving the efficiency by decreasing expenses wherever possible. Key webinar questions. We looked at what is investing. Do we know what investing is now? Yep. Making the most money in the quickest time for the least risk and the lowest aggravation. Thanks for coming, team. And how can you become a more productive investor? Well, we looked at the concept of velocity of money. In future webinars, we're going to look at how you use your time, money, skill, and risk tolerance to try and drive higher returns. Your homework. We can't do it now because we're out of time, but you need to now go away and complete the end of session self-assessment questions. Reflect back over the questions raised in this webinar. Then your homework for later is to reevaluate your current assets, the assets you own at the moment, against the new definition of investment, calculate the rate of return, and identify how often your income returns are compounding. All right, now it's starting to get a bit harder, isn't it? I told you it wouldn't take long for the course to start getting you to press some buttons. Now there's another template that you'll see here, investment evaluation template, that will assist you. There are instructions on how to use that as well. What I want you to do is I want you to spend 5 minutes now with one person sitting next to you, or you can do groups of 3 if you want, talking about what you've learned, what will you change, what will you do, and who will you engage to help you with your investing. Perhaps reflect through some of the things that you've been writing down in your notes over the last session, and then we'll reconvene in 5 minutes. Off you go.